Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. Today we're doing a deep structural analysis, really looking at the financial landscape here in late 2025. We've got two major forces that are, well, they're completely redefining what we all consider safe and what we consider risky.
That's right. Two huge themes, but they both seem to point to one central idea, this concept of global regime risk. It's forcing some major asset classes to really change their fundamental behavior.
Exactly. So first, we're going to head to the commodities market.
Hmm.
We need to unpack this pretty dramatic action taken by the CME group. It's the Chicago Mercantile Exchange on gold and silver futures.
We really do. We need to figure out why they raised the collateral required to trade these metals.
Yeah, and what does that signal about the high-stakes global risks that are, building up just underneath the surface?
And then from there, we pivot.
We pivot to the traditional anchors of safety, cash and long-term government bonds. And we'll be dissecting some stark warnings from giants like Warren Buffett and Ray Dalio. They're cautioning that these supposedly safe assets, they might harbor some surprising risks.
Risks that most investors just aren't really accounting for. Our goal here is to connect these two signals. I mean, what does a technical move on gold futures have to do with Buffett's worries about the US dollar?
It seems unrelated at first.
It does, but it turns out it's everything. We're going to try to translate these complex market signal stuff about leverage, fiscal policy, geopolitics into clear, practical insights, so you know exactly what the data suggests.
Okay, let's unpack this. Let's get
Yeah.
to right there at the end of 2025 with that CME group action. They officially raised margin requirements for gold and silver, and the official line was increased price volatility and market risk.
Right.
Now, for anyone listening who's maybe newer to trading, that sounds extremely technical.
It does, but what's so fascinating here is that this is a critical market signal. It's not just paperwork. To explain a margin hike, let's use a simple analogy.
Okay.
Think of margin like a security deposit you have to put down to rent something extremely volatile. And in this case, that thing is a futures contract, which lets you control a huge amount of gold or silver with a pretty small upfront deposit.
So it's about leverage.
It's all about leverage. If the market is calm, that security deposit, the margin is low. But if prices start swinging wildly, high volatility, the CME, which is sort of the landlord of the system.
Right, they're the ones keeping things from blowing up.
Exactly. So they increase that deposit, and they do it to make sure every single trader has enough collateral to cover their losses if a big leveraged bet goes wrong.
So the CME isn't trying to, crash the price of gold. They're just managing risk, making sure a few bad bets don't take down the whole system.
That's it, precisely.
Wow.
It is all about managing systemic risk. And if you look at the data, the real insight is that the CME usually raises margin after volatility has already been building up for a while.
So it's a reaction.
It's a reaction, and it's a nonverbal signal. They're telling the market that the high volatility we're seeing in precious metals, which is being driven by, intense geopolitical risks, Fed uncertainty, the dollar bouncing around, it's not expected to calm down easily.
It's the regulator basically saying, hey, get ready for more turbulence.
You got it.
So if that's the message, what happens immediately? I mean, who does this affect in the short term?
Well, it hits the highly leveraged funds the hardest. When they raise the margin, it instantly forces certain funds to put up more cash.
So it shrinks their buying power.
It shrinks the amount of leverage they can deploy. And we should probably talk about CTA funds here, commodity trading advisors. You can think of them as these large, often algorithmic funds that chase trends with really high leverage.
And they're the first to feel the pinch.
They're often the first to unwind their positions. When the margin goes up, their models tell them to cut back.
And when a fund like that has to sell off positions, that drives down trading volume and probably puts some downward pressure on the price, right?
That's the historical pattern, yes. Sources suggest you get this immediate reaction. Highly leveraged positions get closed out, volume dips for a bit, and you tend to see a short-term price correction, or at least the volatility stabilizes.
A cleanup, we call that.
It's a cleanup, and it's especially needed for an asset like silver, which can be even more volatile.
Okay, so that explains the short-term pressure. But the short-term noise often hides the real trend. If the CME is just managing the speed of the market, what's the actual direction?
And that's the structural shift that really matters. The bigger picture here is that precious metals are shifting. They're moving from being just an inflation hedge or a speculative play to becoming true macro assets.
What do you mean by macro assets?
I mean, they are now simultaneously reflecting the three biggest global risks out there: currency risk, interest rate risk, and geopolitical risk. all at once.
Let's get into those trends, because a margin hike can't really stop a structural shift like that, can it?
No, absolutely not. The first trend is just massive central bank demand. Data shows central banks, especially in emerging nations, are buying gold at historically high rates.
Why, though? That's the motive.
They are specifically buying it to reduce their reliance on U.S. dollar assets. This isn't just about diversification anymore, it's a direct response to geopolitical tensions, to sanctions risk. A central bank buying gold is buying a non-political reserve asset.
A hedge against the stability of the dollar-based system itself.
That's the foundational force, and it is not going away.
Okay, so that's the geopolitical angle. What about the uncertainty coming out of the Fed?
That's the second factor, persistent Fed uncertainty. All these delays and shifts in the Fed's rate path have created massive volatility in real interest rates.
And just as a refresher, real rates are the yield you get after you subtract inflation, right?
Exactly. And if the market can't decide if inflation is going to be 2% or 4%, and the Fed keeps delaying, the true return on safe assets is always in flux. Gold pays no interest, so it thrives on that uncertainty. It becomes a hedge against the volatility of real rates themselves.
And the third point. This one is about silver, gold's wilder cousin.
It is, yeah, because silver has this really fascinating dual role. It's a precious metal, but it's also heavily tied to industrial demand. I mean, think solar panels, EV batteries, electronics.
So it's reacting to geopolitics and to global growth expectations.
Both. It reacts to macro uncertainty like gold, but also to industrial performance like copper. And because of that, its price swings, its amplitude can be much, much larger than gold's. That's why the margin hike was so significant for silver.
More leverage plus more underlying volatility.
Equals a massive systemic risk concern for the CME. They had to step in.
So if we distill all this, the CME margin hike is just a referee stepping in. It's cleaning up some excessive leverage, but it's not signaling the end of the long-term trend.
I think that's the perfect way to look at it. The core structural demand for gold as a hedge against, let's call it, regime uncertainty that's likely to persist. So while you might get a short-term adjustment, especially in silver, the long-term metrics to watch are still things like ETF holdings and physical demand.
That's a powerful context. Okay, so now let's pivot to the other side of this risk spectrum. The same systemic risks driving gold demand are also affecting what we used to think of as the ultimate safe assets. Which is why we have to look at these warnings about cash and bonds from people like Buffett and Dalio. Let's start with cash. When they say cash is dangerous, what exactly is the risk? I mean, cash can't default, can it?
This brings up the single most important question for investors today. What does default even mean for a fiat currency? The risk of holding dollars is not a nominal default. The government won't suddenly say your $100 bill is worthless. The risk is purchasing power default.
Purchasing power default.
Yes. Buffett was very clear on this in his 2024 shareholder letter, the one that came out in early 25. He warned that persistent fiscal folly, his words, could cause paper currency to rapidly lose value.
Fiscal folly that is strong language from Buffett. What was he pointing to?
He was pointing to the structural incentive that governments with huge debt burdens have, which is the temptation to inflate that debt away, basically by printing more money or just allowing higher inflation.
Which is like a hidden tax on anyone holding cash.
It is. It's an invisible tax on you, the cash holder.
So if you have $100 in your hand today, its face value is $100. But if inflation is eating away at it, next year that same bill might only buy $90 worth of groceries. That is missing $10. That's the purchasing power default.
That's the core concept, and Dalio reinforces this all the time. He argues that when government debt gets this high, non-political stores of value like gold, like productive companies, become fundamentally more attractive than the paper that government prints.
Okay, but then why isn't the advice just get rid of all your cash immediately? There's a nuance here based on interest rates, right?
Oh, absolutely. The role of cash is strategic. It all depends on its opportunity cost. And right now, when real short-term interest rates are positive.
Meaning the yield on cash is higher than inflation.
Exactly. When that's the case, cash is actually an incredibly valuable strategic asset. If you can earn 5% on your cash and inflation is 3%, you have a positive real return of 2%.
In that case, cash isn't eroding?
It's not. It's acting as a powerful liquidity option. It's your ammunition. You're waiting to deploy it when risky assets get volatile or cheap. The real danger is when your cash yield is substantially less than inflation.
That distinction is key. Okay, so let's move to its cousin, long-term government bonds. Why are they, the traditional safety net, now considered so risky?
The warnings here split into two big weaknesses. The first one, which Buffett also hit on, is the weakness of the fixed coupon. If you buy a bond today that pays you 4% for 30 years and inflation ends up running at 5%,
That fixed income stream becomes less valuable every single year.
it gets debased right along with the currency. That's the simple inflation risk.
Right.
But there's a deeper, more 2025 specific risk here.
And that's tied to policy credibility.
It is. It's policy and fiscal risk. The IMF's Global Financial Stability Report from October 2025, it warned about this. It said that because of large U.S. fiscal deficits and all the debt being issued, the Treasury market is now relying much more heavily on price-sensitive investors.
What does that mean, price sensitive?
Think of it this way. The government has to sell a massive amount of new debt. If the traditional buyers, like foreign central banks or pension funds, start to step away,
Then they have to sell it to someone else.
they have to sell it to speculative investors who demand a much higher return for taking on that risk. This makes the whole market more fragile. If those investors get spooked by, say, a crisis of confidence in the government's finances, they can suddenly demand huge rate hikes on that long-term debt.
And a sudden jump in long-term rates would cause massive losses for anyone already holding those bonds.
Massive losses, and it would stress the entire banking system. This means long bonds. They're not just an anti-recession asset anymore. They have essentially become a bet on the policy regime.
A bet on the policy regime.
You are betting over 30 years that inflation will stabilize at 2% and that fiscal credibility will be maintained. If the market loses faith in that second part, long-term rates could jump overnight.
So for investors, it's not just about how many bonds to hold, but what kind of bonds. Maturity structure.
That is the key takeaway. If you hold long bonds today, you are taking on the tail risk of a sudden loss of confidence in fiscal policy. And tail risk, just for the listener, is that low probability, high impact event that can be catastrophic. And that risk is just higher today because of the scale of the debt.
This really brings us to the synthesis, doesn't it? The CME's action on gold, the warnings on cash and bonds, they both point to one central theme dominating the market: regime risk.
I agree completely. We're moving into a market where these big structural forces, geopolitics, debt levels, policy uncertainty are just more important than short-term price movements.
It all seems to boil down to the perceived stability of the whole system.
It does. If the world gets more volatile, the system demands more collateral. That's the CME hike. And at the same time, the historically safest assets, cash and bonds, they become less reliable.
So, practically speaking, what does this mean for us? It doesn't sound like we should panic sell everything, but we do need to assess our portfolios differently.
I think you need to ask two key questions. First, is my cash generating a positive real return? If yes, it's strong ammunition, it's preserving your capital. If it's losing ground to inflation, you have a structural problem to solve.
Okay, that's number one.
And second, am I prepared for the tail risk of a long-term interest rate jump? That jump, caused by a loss of fiscal confidence, is the single biggest threat to long bond value. You have to have a plan for that risk.
And this ties back to Buffett's ultimate message, which isn't just about avoiding losses. It's about owning productive assets, like great companies, and real scarce assets, like gold, that can actually survive when the stability of paper money is questioned.
And that leads us to our final provocative thought for you to think about: the shift of gold and silver into macro assets. It reflects a growing global doubt about the stability of the dollar-based financial system. So while the CME adjusts margins to manage the speed of the market, the central question for you as an investor is this: what part of your portfolio is truly protected if the perceived safety of government debt is what really begins to wobble?
That is the essential question for 2026 and beyond. We covered a massive amount of ground today. The CME margin hike is a volatility signal, gold's new status as a macro asset, the hidden risks of purchasing power defaulting cash, and the major fiscal policy risk now embedded in long bonds. Thank you for joining us for this deep dive. Don't forget to subscribe and hit that like button.